Hello and welcome back to Real Talk with Realtors about real stuff, real things, and whatever else comes to mind. Today we have very special guest, Bodie Shepherd of Motto Mortgage here in Chico. We are super lucky to have you right down the hall.
Thank you.
And literally at our beckoning call for any questions that we ever have as a group. Like today. And, you know, finessing you to be on this podcast. So today we want to talk about what are the first steps to, or not first steps, but really what does a first-time home buyer need to do to finance their home and like understand the money part of buying their first home, because obviously that's one of the most important things and one of the most complicated things.
Yeah.
So if you were talking to a first-time home buyer, very first time ever, what would you tell them?
That's a very
too broad?
No. That I think really getting to know what your budget is first. So there are parts to obtaining a loan that are step by step, but getting an idea of what you want to spend monthly, the first question I ask is, what do you want to spend and how much cash do you have? That's the question that we ask. So that would be step one. But getting in touch with someone like myself that can help get some information to them and look at your credit. The very first step is you need to know where you stand with credit. We were speaking earlier, Brandy and I, and one of the problems with being a first-time home buyer is when you're done buying for the first time, you still don't know what just happened. Like, it's not until you buy it a couple times or you hear it after that you really kind of figure it out. But there's 4 parts to obtaining a loan. The property being the main part, finding a property, but credit and income and assets, those all have to check the boxes. So, you know, we start with credit and we pull your credit and see where you are, and that will determine the loan type that we use. So I would say that's the very, very first step.
What happens if you find out your credit is not ideal? Can you still buy a house?
Yeah, it doesn't have to be perfect in line. There are ranges for scores. You know, down near 600 is a little harder to obtain a mortgage. But when you have some errors, they're fixable. I think there's probably, the number is like 75% of credit reports have some sort of error. So it's really important to look at it early in the process, because if you find a house and you want to buy it and you pull your credit and there's problems, then you're going to miss out on that one.
Right. So you need to take the time to fix the problem and then move forward from there. And does it affect your interest rate if your credit score is high or low?
Yeah, actually, they're changing that in May. It used to be that if you were in that 620 to 660 credit score range, you weren't getting the best interest rate. They have changed it now to where the 620 to 660 range is almost the same as having a 700 credit score. So that's changing. But yes, it does have an effect on the loan type also. So if you have a low credit score, you might only have one option.
Okay, so what is the next thing you would look at after credit score?
Income. That is the deciding factor on that debt versus income ratio, right? So everyone's paid a certain way. If you're W-2'd, it's really easy to calculate your income because we can usually average your W-2. If you're self-employed, then we need to look at your tax returns because likely you're writing off many of your expenses so you can have the least amount of tax liability. That works everywhere except for at the desk of a mortgage professional. So getting your income, that establishes where you can buy, because the only way to change your income is to get someone else to buy with you. So you really need to know where you are. And it's not always cut and dry on how your income is calculated. So it might take us 3 or 4 days to reach out to your employer and get some more info. So it's really important that that income gets started right away.
Are tips, your server, something like that, included in your income?
Well, typically, I know they're reported to the IRS, but the tips, just like commission income or bonus income, they have to be averaged out over a 2-year period. So yes, they can be used. We get a verification of employment from the employer that will lay out what they earned in tips.
And then I had another question. Oh, how is debt to income ratio calculated? What does that mean?
Yeah. So the debt to income ratio is just basically a division problem. How much is your gross income divided by what the total expenses are? And that will give you a percentage of, if you divide it and it's like 660, you did it backwards. Mm-hmm. So put the numerator to the denominator and switch it. So yeah, that's just a calculation.
So it's your monthly expenses or yearly gross or monthly gross?
That's a great question. So we look at everything on a monthly basis. Okay. If we have an annual salary, we'll divide it by 12 and get our monthly. The expenses, there's two parts. We call it a front end ratio and a back end ratio. The front end is just housing. So if you make $5,000 a month and your payment is $1,000, then you have a 20% front end ratio. So it's just, again, another math problem. The back end is your car payments, your installment loans, your credit card debt, and your mortgage. That number needs to be at or below 45%.
So basically, it's just the difference between your income and how much you owe in debt.
Yeah, it's a really easy calculation. If you make $6,000 a month, you multiply that by 45%, and that's the max monthly expense you can have.
Okay. And if you're over that, then maybe you could pay off some credit cards or pay off your car, and that will change that ratio.
Pay off car, refinance a car, get a cosigner.
Okay.
That's, whenever we go to credit and someone has good credit and we can move to that next step, if they don't have enough income to qualify, but maybe has someone that's going to move in and rent with them to help with the payment, then we might ask for a cosigner to come in. And that cosigner basically is someone that adds income, credit, and assets to the file, but they're just not living there. So their debts come with them too. So that's the only tricky part with that.
Gotcha. But there's ways to figure these details out if you're motivated enough to get a mortgage.
Sure.
So you said income was the last step. What is the next step?
So
maybe how much money you have?
Yeah. How are you going to do this?
Right.
Do you have a down payment? Do we need to talk about down payment assistance?
So yes, we do.
Okay.
What is down payment assistance? And maybe we could talk a little bit about how much do I need? How much money do I need? And what if I don't have all the money? What if I've got some of it? Can my parents give me some of it? Those kind of details.
Yeah, that's a good question because gifting is a big part. We call it a gift in our world as an asset because it's a gift. When you go into that down payment range, it's 0% to however much you want to put down. The 0% loans are USDA loans, VA loans, and any of those down payment assistance loans end up being zero down payment for the down payment. There are still closing costs. The down payment assistance loans are basically you get a 97% loan. And in California, we have a couple grants. We have Cal HFA and we have a Platinum. I'm not sure if they still call it the Platinum. It's been a bunch of different names, Golden State. But they provide a grant to the buyer in a silent second, meaning they don't have any payments. And so it's a way that they can get that grant assistance. Those all have guidelines. So if you aren't really in need, meaning you earn $100,000 in our county, because Butte County's median income is, I believe, $48,100. So if you make double that, you're likely not going to get any down payment assistance because they're built that way.
So you have to qualify for the down payment assistance.
Yes.
Or if you have 20% down, that's great too, because then you won't have the mortgage insurance.
Correct.
Okay. So it's as little as 0% down. You will have some closing costs, which could run you $10,000 to $15,000. I mean, or do you not like to give?
No, I like to say like $6,000 to $8,000, depending on the sale price of the home.
Right.
Because if we have less than 10% down, we have to impound taxes and insurance. And most times of the year, we're collecting 4, 5, 6 months taxes. So if it's a $600 a month tax obligation, then that's, a little over $3,500 just in taxes.
Okay.
Okay.
Right.
Yeah. So
Upfront.
if you include the taxes and insurance, and it's the average home in our market, close to $400,000, it's going to be about $7,500 in cost.
Okay. That's good information.
Can I add something on the mortgage insurance real quick that we talked about earlier? We were talking about with today's rising interest rate environment, are there any tips or tricks that we can do as lenders to keep the payment low? And when you have less than 20%, you have mortgage insurance. The mortgage insurance is to ensure, I think you guys know this, but just for the listeners, to ensure that if you default, that mortgage insurance company will give a portion of your loan to the lender. They'll basically help them out prior to foreclosure. So there's a couple ways that you can get rid of that monthly mortgage insurance. You can buy it out, meaning instead of making a $100 a month mortgage insurance payment, you can spend $3,800 and not have it monthly. That sometimes obviously increases closing costs. In the last say 6 or 8 months, we've also been doing some buy downs, both permanent and temporary buy downs. And a buy down is spending money to lower the interest rate. There's a couple different ways. Usually we ask the seller to give a credit to the buyer in the amount of a couple percent, say 2%, and then we use that towards getting rid of that mortgage insurance. We also use that to buy down the rate. So that credit from the seller can serve two purposes. So we look at the temporary and the permanent and see which makes the most sense.
So your closing costs can really vary because you do have your standard lender fees, appraisal, title, and escrow, but then you have these variables.
Yes.
Such as mortgage insurance and interest rate buy down.
Yes.
So depending on the decision that you make with your lender and what makes sense for your in particular situation, your closing costs will vary, which is another reason why it's important to talk to a lender up front, because you need to figure out what you can spend. Because if you have more cash in your pocket and you can use some of that to buy your interest rate down, then you in turn can possibly afford a larger purchase price because your mortgage is going to be smaller because you paid your interest rate down.
Correct.
That makes sense. With that being said, what is the last thing that you usually look at?
Well, kind of all that together determines how you move that next step. So it used to be, when I started in this business a couple days ago, we only did manual underwrite loans, meaning there was an actual underwriter that looked at everything. Okay.
Right.
We still do that where an underwriter looks at everything, but now it's all automated. Mm-hmm. So the last thing, I think there's obviously some logistics in there that we kind of jumped over, but the last thing is to run that automated approval.
Okay.
You have someone looking to purchase a home. They come to me. We start looking at those things and determine we have enough cash. We know the ratios are good. Then we push a button and run an automated decision. So that is either through Fannie Mae or Freddie Mac. Mm-hmm. And that automated decision tells us what paperwork we need to get them a loan. So it makes it really easy to know what you need. If you have a low credit score, we talked earlier, if you're down near 600, you might have one option. A manual underwrite is where they're going to look at everything. Mm-hmm. But on an automated decision, when you're down below 620, Fannie Mae, Freddie Mac, they don't like scores down that low, especially if there are other risk factors like high debt to income ratio and not a lot of assets. So the last piece is really getting that stamp from the underwriter. And what most lenders do, what we do is we get that approval before they even get in your car to make sure that they can buy what you're looking at. So that's the last piece, I think, tying it all together.
Yeah. So this just popped in my head. If you are a Dave Ramsey fan, then you probably have heard you can do manual underwrite. Like that's the first time I'd heard of it years ago was you do not need a credit score because if you're Dave Ramsey and you have 0 credit score because you followed his stuff to a T, then you can do manual underwriting. But does that still affect your interest rate if you have a 0 credit score?
Yes. 0 credit score back to the low credit score. It just means that you're very limited.
So it's still treated the same as if you had a 600 or a 580?
I don't know that it's treated the same. Mm-hmm. I would think it's a little worse than having a low score because you'd have no credit established. But most people that have had debt that paid it down have some sort of score. They just don't have recent activity. Mm-hmm. So that is something that the computer will pick up. But there's not many options for no credit score.
Okay.
But you do have the ability to use your PG&E bill, your cell phone bill as alternative lines of credit. And those credit supplements that we provide are in lieu of a score. Okay. So there are options.
Awesome. Well, I think that wraps it up.
Well, yes, it does. But I want to say a couple things. One, so let's just reiterate all of them. The first one was run your credit.
Yes.
Second is determine your income. Third is figure out how much money you have. Fourth is to run it all through the automated system, and that's also going to tell you what you qualify for in terms of how much house you can buy.
Yes.
Your price range. And if you are somebody that is looking for a home, whether you're a first-time home buyer or not, Bodie is very low-key, no pressure. I mean, it's just give you a call or shoot you a text or send you an email and say, hey, here's what I want to do. And you can chat with them over the phone or have them come in the office. It's a pretty simple process. And see what you might qualify for anywhere in California.
You missed the very first step that we just touched on is the budget. Make sure
Oh, yes.
before, because there are times when I have couples come in and sit down with me and I say, okay, what do you want to spend? And they both go, I don't know.
Yeah. A little marriage counseling going on there.
Yeah. So knowing what you want,
Okay.
you know, I like to say, when you write that check every month or do the bill pay, what's going to make you feel okay and what's going to be too much?
Right. Because some people qualify for more than what they're comfortable with at
Usually
times.
always.
Yeah.
Usually always. It's pretty rare. Most folks come and sit down and they say, I don't know what I qualify for, but I really like that house that's $400,000. Do I qualify? And then they find out they can qualify for $800,000, but they want the payment of the $400,000 house.
Right.
So,
which is great.
which is why I always want to know that question, because I have people ask all the time, well, how high can I go? And then I always say, but that goes above your payment. Why are we even having that conversation? So,
And as realtors, it's always a good idea to do this process before you go out and look at homes, because you might find a house that you fall in love with and don't qualify for, and that's always such a bummer. Or like Bodie just said, vice versa. You actually wanted the bigger house, but you didn't think you could qualify for it. So what's your contact info? How can people get a hold of you?
So I am on Instagram at Bodie Loans. Tried to make it easy. My phone number, 530-624-2482.
And it's Bodie, not Brody.
It could be Brody. It's fine.
Whatever.
Whatever. Not if they're trying to find me on Instagram. BODIE.
All right.
There you
Awesome. Thanks, Bodes.
Thanks for having me. This was fun.
We'll get you on the next one, too.
Okay.
Peace out.
Girl Scout.
Later, Gator. Wild crocodile.